Hello everybody. We'll talk about wealth management and personal finance in this video. So exactly what we will talk about it. We'll talk about how to create wealth and probably how to nurture wealth through solid habits, solid personal finance habits. Remember, so the saying goes that do not consume the seed, your current earning as such. Whatever you earn, do not consume everything. Plant it. Probably later consume its fruits. That would be much more satisfying. Direct your money where it should go now so that you can ask later in life where as in where did it went, where did it go. Introduction. Now what are we looking into as far as personal finance is concerned? So personal financial management is mandatory in today's world. It is a hard reality. It provides the means of keeping a track of personal expenses, personal debts, and subsequently helps the calculation of person's net worth financially. The following are some of the tools that have been used in personal finance management, as in the income and expense sheet. Its preparation is key to the personal financial management. Now, how do we go about how to calculate the income level? Let me tell it to you. This is the sum of all post-tax income or disposable income, wife or husband's income, your spouse income, if I may say so, investment income, rental income, and other sources of income thereby. Next is the calculation of expenses. This include expenses on grocery, medical help, house help, laundry, basic amenities, phones, transportation, household expenses. Lifestyle expenses include expenses of books, newspaper, clothing, personal care, entertainment, travel, holiday, eating out, and club or gym membership thereby. Fixed expenses include expenses on house rent, children's fee, home loan, auto loan, installments, and other loan installments and insurance premium thereby. Household gadgets, festivals, and family obligation, and the likes are included under the miscellaneous expenses thereby. So, what are we looking as far as person's financial net worth is concerned? Remember, net worth is calculated by the difference of assets and liabilities. Assets includes every fixed property like the land, the house, the farmhouse, the bonds, insurances, fixed deposit, mutual funds, small saving, provident fund, a mounting saving account, a mounting current account, cash in your hand, and other sort of investment. So, what are my liabilities? Liabilities includes the loan that you have. I'm talking only about the personal finance, mind you. The loan in terms of housing loans, auto loan, personal loan, consumer loan, any other borrowings, unpaid bill, credit card, bills outstanding, and other liabilities. A positive net worth would allow further future financial plans thereby. So, assets, anything having commercial and probably exchange value that is owned by a business, institutions, or individual. Appreciating assets are those that generally increase in the value. Example, real estate, bonds, stock. Depreciating assets are those that generally decrease in the value. Example, car. So, what are we looking into it? Let us club account, a type of saving account a customer joins to save money for special reasons such as holidays, such as family vacations, such as anything that the customer is intending for a big purchase, big ticket purchase. Club accounts usually require the customer to make regular deposit, diversification, spreading the risk of loss by investing in a variety of saving and investment options. Dividend, part of the company's profit, it gives back to shareholders, as in that own stocks the company. So, what is inflation? Inflation is the rise in the price of goods and services. It happens when there is too much of spending relative to the supply of goods at the market. So, if you have too much of demand and too less a supply of goods, so inflation would go around it. It will prices of goods and services will spiral up. Interest, the cost of borrowing money or the price that the lender charges the borrower for the usages of the lender's money. Interest is also paid on the deposit because they are in effect to loans to the bank, perhaps. So, we talk about investment, a saving option purchased for a future income or financial benefits. Liquidity refers to the ease with which assets, something of value, can be turned into cash without losing its value at all. For example, cash is the most effective liquid form of assets. Risk versus reward. This is a very interesting term. The amount of risk that you take and the amount of reward that you expect. there has to be a parity. This refers to the trade-off between the risk and the return. The more the risk an investor takes in an investment, the higher the expected return on investment. But believe me, the risk might be too big, and your all your investment might go down the drain. So there is a higher risk of possibly losing the entire amount. Remember, that is what I said. Stocks owned in a company, the price of a stock may vary depending on how well the company performs. The value of the investment may increase or decrease. Personal financial priorities, the income earning, saving, investment, spending, borrowing, doing nothing financially as a case might be. Next, about your personal finance is your debt. If you can manage your debt, everything is one. Personal debt management, another vital aspect of financial management is the personal debt management. In order to keep a track of the pending payments, avoid falling into a debt trap, a number of aspects needs to be considered. In case of an auto loan, housing loan, personal loan, or for that matter, any other loan, one should keep an account of loan amount, the repayment period, the monthly installment, the interest reset frequency, and the amount of the loan that has been paid off. So why do we get into debt despite knowing the fact that this is vindictive to our financial health? Because we spend more than we earn, because we want to have what the neighbor, colleague, friend has, because the lure of easily attainable loans, we borrow the pay back other loans. We often borrow to pay back other loans. So what is a good debt? And there is a bad debt also. Debt for investment, example, business, buying shares can be risky though. Mortgage, where you should aim to pay as quickly as possible. When you mortgage something, probably the interest rate is a wee bit lower. Then what are my bad debts? Your debts for consumable pleasures, luxury, which are not essential but mostly out of desire that you go and make a purchase. So to get out debt as fast as you can, possibly, how was the question? That is what I would love to answer. Plan what you borrow. Plan when you borrow for investment. Plan not the consumable, you unless it is for a mandatory reason. Maximum one third of the net pay is a loan repayment. One third of your income might be. Thou shall not covet. Don't borrow things that you desire, but don't need. So desirable thing is not the thing for which you would actually take borrow loans, right? That is what, if it is essential, probably we can think of it. Let's say, what is an essential for which you need to take a loan? Education, for example, or medical exigencies. Avoid borrowing on consumption items like car, holiday, furniture. Managing debt, and how do we go around it? Write a list of all your debts. Prioritize your payment. Pay interest bearing debt first. Pay a loan as quickly as possible. The longer the term loan, the more the money that you are willing to pay. Avoid credit card debt. It is one of the most expensive. Even the ATM. Avoid a saver mentality that you can't save for everyone. Save for yourself. Save for your family first. Family, friend, cheapest and most understanding of creditors, but do not exploit them. Record your expenses daily. Plan where to cut down as on when on basis. Create a budget. Most importantly, don't only create a budget but stick to it. Are you an impulsive shopper? Keep your credit card, your ATM card at home. Do not go to the shopping or marketing complex with your ATM or credit card, because instinctively you may make a purchase. School fees pay in monthly installment. Use the tips on achieving financial security. Building versus mortgaging, as in payout versus stake out or take a loan altogether. So managing debts, please note, in your monthly saving, pay yourself 20% of your earning, whatever you earn, right? Yourself. It is for you that you want to spend on. 30% on is for the expenditure, 20% is for debt related investment. 10% is for things spend if as and when on required. There might be urgency, there might be exigency, there might be just a likelihood that you might fancy certain spends expenditure. 20% hopefully should be there for charities and community support. So seven biggest mistake before I wind up. The most common roadblock of building wealth. Remember, wealth management is what we are talking about, wealth management and personal finance. So allow me to give those seven biggest money mistakes before I wind up this video. Many of us will never reach their dreams of building wealth, being financially secure, being able to retire in comfort. The reason is the most often a combination of these seven biggest money mistakes. Number one, have a 30-year mortgage. Where do you find the money to build wealth? If you try looking at your mortgage, if it is for 30 years, you already in your debt for a life. Millions of people think nothing of paying for their home over 30 years, even though the average homeowner ends up paying 2.5 times the purchase price of the home. By stretching the payout this long, having a 15-year mortgage instead of 30-year mortgage can save you a large sum of money, help you build a wealth. Second, give control of your money to someone else. If you're not involved into day-to-day family finances, you're putting yourself at risk. If you're married, let your spouse handle all your financial matters without giving your input. You are at risk if your spouse dies or becomes seriously ill. If you divorce, know the details of your family finances, investment, debts, retirement. These are my 7 biggest money mistakes, to be avoided. Next, don't turn your investment, financial affairs over to a broker or a financial consultant without keeping abreast of what has been done with your money and being involved in your investment decision. Never give a total control of your money to someone else. Not controlling our spending leaks. The reason so many people in across the world are in so much of a debt because they dribble their money away in small, barely noticeable amounts. Like a drop of water dribbling through the hole in a dike, the loss is barely noticeable, but over a period of time, it gets bigger and bigger without you coming to even know it. By the time the water is gushing out through, the damage is already done. The same is true with the spending leak. It is a lot easier to plug a small hole than to ignore a drips. And look for your shoulder later and see the huge tidal waves of water coming away in the form of unmanageable dips. If you're ever going to accumulate wealth, you must control your spending leaks. Fourth, not setting goals. If you don't know where you are headed, how you plan to get there, you probably will never arrive. To accumulate wealth, you need a plan. To be motivated to save money, you need something specific to save for. To succeed in accumulating wealth, write your goals down, visualize them, whether they are relaxing, retirement, a mortgage-free home, or an unforgettable vacation. Fifth, incurring too much of debt. If you're spending all your money paying interest on credit cards and installment debts, you won't have enough left for saving. When you buy on credit and don't pay the balance at the end of the month, you end up paying much more than what the purchase price was all about it. Remember a 12,000, if it is a dollar that we're talking about it, big screen TV can end up costing you approximately 10 times the price. In fact, 20 times the prices if you never know what is the true cost been hidden in your credit card. That is what you need to go around here. Pay cash. Stay away from credit card if you want to accumulate wealth. The sixth is cashing out on a retirement plan. That is what is then been done. Many people end up cashing out their pension plan when they change jobs. Still, other take loan against their pension balances, permanently reducing the amount of earning that they would have accumulated over the span of things. The last one, not saving enough for retirement, or probably even starting too late. When you are 20s and 30s, it is easy to think that you will have a whole of a lifetime in the world to accumulate wealth and save for retirement. The truth is, you will have to save a lot less if you start now and give your earning times to compound. If you're over 40, you are behind your retirement savings. You will be able to save much larger sums to ever catch up where you should be. Start saving early and save at least 20% of your income, and you'll be well on your way to accumulate wealth altogether. Remember, personal values and money management is to save, is to spend, and thereby it will enable to grow your money. This is my core personal values. First, make money, then save those money before prudently spending those money. And believe me, if you're saving it, you're actually multiplying, having the compounding effect on the money for growing. So, just to wind up, finally, you should have a big dreams. Start now what you have, where you are. Never ever give up. Surround yourself with people better than you are, what you can possibly be, and they're positive in life. Consistently add value. Trust in God, and I'm sure all of you will die rich. Thank you very much for watching this video till the end.